So welcome back. Today we will do another essay question on budgeting area, and this one will talk about flexible budgeting. Okay, very interesting topic and must question in exam. Okay, either in the form of essay or in the form of MCQs. You will definitely find this topic. So my friends, exam technique, first read the requirement. What is the requirement? There are four requirements. First of all, they are asking you identify and explain three benefits of using a flexible budget. Okay, very simple requirement. We will see this. Then they are saying prepare flexible budget from operating income at the 55 million sales level. Okay, you don't know anything about it. You just know that we need to prepare a flexible budget. Even you don't know what is flexible budget, right? So I will tell you, don't worry. Identify and explain three possible reasons the company's sales have increased, but the company's income has decreased. So we need to tell them some possible reasons about this situation. Okay. Now you should understand this point that in your essay questions in exam, there will be some requirements which have no relationship with your book knowledge. Getting it? So they will ask you some requirements, like one or two at least, in which they will try to test your business understanding. They will try to test your business acumen. Getting it? So be ready for that. They will ask you, okay, what other factors to consider in this decision, right? What are the possible reasons for this situation? Like that. So there is no one answer for that question. You will write something, I will write something else. Getting it? So be ready for that. What is question number 4? We need to define zero-based budgeting also. Now, before we start, you should remember last time we already discussed that what we have actually in this area, right? We need to know about different types of budgets, in which we have flexible budget also, we have cash budget also, we have zero based budget also, right? And other manufacturing budgets like material budget, labor budget, overhead budgets, cost of sales budgets. So all of these you need to know. Getting it? Now see, in essay question, most probably they will not ask you to create budgets, full-fledged budgets. No, because it's essay question, right? So most probably it will come like this, like the one in front of you, a mini type of budget question. But in MCQs, they will test you for all these budgets, like for the cash budget, for the overhead budget, labor budget. We will see MCQs later on. Just I'm trying to tell you that don't expect that they will give you a full-fledged question to make budget. Getting it? Because time is not allowing for that. You have only 30 minutes to solve one essay question. And if they are calling it an essay question, it means there will be theory. Okay, the purpose of essay question is to test your theoretical knowledge more as compared to calculation. Anyways, so let's start. They are saying the company, which is Biscayne Industries, manufacture tents in a variety of sizes by using a variety of materials. Last year's income statement data is shown below. Now see, this is last year income statement. They gave you sales, cost of sales, gross profit, selling and admin, operating income. Okay. Okay, please write in the chat box, this income statement is by using absorption costing or variable costing. Yes, please. This income statement is by using the absorption costing or variable costing. Very nice. Okay, this income statement format is from the absorption costing, which we discussed in the cost management area. How I can say that this is from absorption costing? Because this is a gross profit format, right? In variable costing you have, which format you have? In variable costing you have contribution format. It is called contribution margin format. Getting it? in which we write sales less variable cost, contribution margin less fixed cost is your income. Anyways, now see, they are saying you that last year we sold 100,000 units, okay, and the revenue was $50 million. Cost of sales were 30 million, gross profit was 20 million, selling and admin all fixed 12 million, and operating income is 8 million. Okay, please make a note of it. Whenever they will ask you a question on flexible budgeting, you need to look for this thing, that what is my fixed cost. Getting it? Although this is from absorption costing format, but we need to know the breakdown. We need to know that which cost is fixed and which cost is variable. I will let you know in a while why we want to know this. Getting it? So the first point to note is, in flexible budgeting question, you need to be careful that which cost is fixed and which cost is variable. Now they're saying you that, okay, let me know in the chat box, how much of the cost of sale is variable in dollars? Can you tell me? If 2/3 is fixed, how much of the cost of goods sold is variable cost in dollars? Very nice. Getting it? So 30 million is the total. So 2/3 is fixed, means 20 million is fixed, and the remaining 10 million is variable. Okay. But in selling and admin situation, all the cost is fixed. Very nice. So my friends, they are saying you in the next paragraph, they are saying you Biscayne did not foresee any changes for this year. So it created a master budget that was the same as last year results. So this last year results which they have given you above, you can take it as it is your master budget of the current year. Getting it? Okay, tell me in the chat box, is this a good strategy to take your last year actual results as the current year master budget? What can happen? Remember, from the last class we discussed something. What was that? If you will do this, what is the chance? What is the risk? Very nice. The risk is for budgetary slack. Okay, what is the slack? When you overstate your expenses or understate the revenue in while making your budget. Getting it? To why we do this? To make the targets easily achievable. Remember? Okay, and how to avoid the budgetary slack? Don't look at the last year. Start from zero. Remember, zero based budgeting. So zero based budgeting approach is, you start from scratch. You say, okay, we don't have the last year figures, forget about it. Bring your figures and justify every single figure, so that you can try to remove the slack. Again, see, risk can never be eliminated, right? So there will still be some slack, but it will be very minimum. Getting the story? I mean, uh, for your, for example, for your children, you are setting the pocket money, okay, monthly. Now, initially, you have set yourself pocket money, for example, $50 per month. Later on, they came to you, they said, $50 is not enough. We have other type of expenses also, so we need at least $200 per month. They told you this, okay? So one option is, you will allow, you say, okay, no problem, I will give you $200. And the other option is, you tell them, forget about $50 now. Okay, bring a paper and a pen and write your expenses. What expenses you have? So they will tell you, okay, per day we travel, this is our bus fare. Per day we need this much for school expense, cafeteria. Getting it? And this and that. So when they wrote all this, it totaled only $35. How much it totaled? Only $35. So you said, okay, now your pocket money is $35. Getting the story? Because they don't have any other list thing to list down. They have nothing to justify more. For example, I'm just giving you example. So basically, see, the previous budget was 50, and they came up with a requirement that we need to increase this, and you said, okay, wait, come to me and justify all the figures you have. and eventually the budget did not increase but it decreased. Getting it? So we found out there was a slack of $15 and we took that from them also. Getting the story? So my friends, this is the problem if you are using last year actual data as a budget. But see, the good thing is, what is the good thing? It is very simple, right? It is easy. It is not taking time, right? So in this situation, it is good. But on the other side, the disadvantages are more. So definitely, you cannot say that there is a single uh, budgeting approach which is better. You need to see from situation to situation. Maybe for this company, using the last year data is feasible. You never know. Getting it? But we don't have enough information to conclude that this approach which they used was justified or not. And by the way, this is not, examiner is not asking you this thing. This is, I am just brainstorming with you, because examiner can ask these types of questions also. They can give you a requirement that, okay, what is the benefit and problem of using last year actual results as master budget? This is not a requirement in this question, but they can ask you very well. Getting the story, everyone? Okay, so my friends, please write yes in the chat box if you got the point. So moving on, my friends, if you see, they are saying you that at the end of this year, I am here in the middle of the paragraph, at the end of this year, however, the company sales totaled 55 million. If you see how much is the budgeted sales, this one, right? 50 million. And how much is the actual sales for the current year? 55 million. There were no variable cost variances and the company's operating income was 7.5 million. Okay, how much was the operating income we budgeted? 8 million, and actual is how much? 7.5 million. Okay, so these four figures actually we need to see. We need to focus. Now see, first of all, before moving on, let me give you an example to understand basically what is a flexible budget. Okay, so for example, you have two cars. You have two cars. Okay, one car is a Ferrari car and the other car is Toyota Corolla. Okay, Toyota Corolla for your driver, Ferrari for you. Okay, your friend is coming from the other country and he asked you to pick him from the airport. You called your driver that, this is the flight number and please go tomorrow to pick my friend from the airport. Your driver, and you told your driver, okay, please try to reach there before like 15-20 minutes, so you are available there before my friend comes out. Okay, so the next day, uh, you called your driver and you asked him, you reminded him actually that please go to the airport and this time and pick up my friend. Now what happened is actually your driver went to the airport and he took a selfie and he sent you the selfie that I am at the airport. Getting it? And behind behind your driver, the car was not Corolla, the car was Ferrari. The car was Ferrari. So basically your driver took your Ferrari. So you said, okay, fine. You said how many minutes you took to reach the airport? He said, I took 10 minutes. I took, he said, I took 15 minutes. How much? I took 15 minutes. You told him if you are using Ferrari, you should take only 10 minutes. Getting it? Okay. Basically, it was in your mind that if he will use Corolla, he will take 20 minutes. If he will use Corolla, he will take how many minutes? 20 minutes to reach the airport. And he said, see, I reached only in 15 minutes. I reached only in 15 minutes. So actually he is trying to tell you that he has saved time. Okay, he is more efficient because instead of 20 minutes, He reached to the airport in 15 minutes. Getting it? Now you told him that 20 minutes was for Corolla, not for Ferrari. Now if you are using Ferrari, I will not evaluate you on 20 minutes. I will evaluate you on 10 minutes. So basically you have not saved 5 minutes, you have wasted 5 minutes. Getting the story, everyone? This is the other angle. So basically this is called flexible budget. What is flexible budget? That we are saying that you are using Ferrari instead of Corolla. So I will compare you on Ferrari versus Ferrari. I cannot compare you on Corolla versus Ferrari. Getting it? But he was saying, I saved time. But we are saying, no, you wasted time. Right? Everyone getting the story. Now see here also I will open up the Excel sheet now to explain you more. Now see here, I am giving you this example here. Okay, this Excel sheet I will share with you. Okay, don't be confused. I will explain you item by item. First of all, you need to understand what is flexible budget. Okay, if you see in this yellow color, flexible budget in simple terms, it means that what should have been done. Getting it? What should have been done? This is called flexible budget. Now see, I have created 3 columns here, right? Whenever examiner is asking you to create flexible budget, you need to make how many columns? 3 columns. And what are these 3 columns? The first column is master budget. Master budget is also called static budget. Getting it? Because it's fixed. Static means it's not changing. We will not change the master budget. Getting the story? Okay. Now my friends, the second column you will make is for actual results. And the third column you will make is for flexible. Right? Okay. Now see here. I am assuming these are assumed figures. Okay, please note these are assumed figures. Now I am telling you that I have a budget in which the units are 10,000. Assuming these are units produced and sold, we don't have any opening and closing inventory, right? So we are saying that we have budgeted that we want to sell 10,000 units next year or in the current year. At the end of the year, we got to know that we have sold 15,000 units. Getting it? We have produced and sold how many units? 15,000 units. Okay, now see, the first question is, while you are making flexible budget, you will write here what? In this blue area, what you will write? Basically, you will write 10,000 or you will write 15,000. Getting the point? So the answer is we will write 15,000. Why? Remember my example of Ferrari versus Ferrari? So this 10,000 is basically Corolla. What is this 10,000? Corolla. Actual is Ferrari. So when you will compare the actual results, you will compare with the Ferrari output or with the Corolla output. Ferrari output. Getting the story? With Ferrari efficiency. So again, what I am trying to say, what should have been done? I am telling to my driver, if you are taking Ferrari, you should have taken 10 minutes. You should have. See this? But you took how many minutes actually? 15 minutes to reach the airport. Getting it? So don't tell me that you have saved 5 minutes. Actually, you have wasted 5 minutes. You took more 5 minutes. Getting the story? So the first point to remember is when you are making flexible budget, the units you will use are the actual units, not the budgeted master static units. Please write yes in the chat box if you got this point. The first point you should remember is when you are making the flexible budget, the units you will use will be actual units. So see this blue means same. I have highlighted this blue means whatever is written here you will copy paste here. Okay. Now moving on my friends, actually I have calculated the revenue. Okay, and how I have calculated the revenue I will show you. This file I will share with you, so don't worry. Now see the formula. Basically I wrote here in this box here, I have written here that my selling price is how much? 100. Can you see here? This one I will highlight in orange color. How much is my selling price? $100. Okay, if my selling price is $100, so how much should be my revenue? Getting it? 1 million. How I know this? 10,000 multiplied by 100 is how much? 1 million. Getting it? This is my master budget. Then I went to the cost of sale and I said, okay, my variable cost. How much is my variable cost? 400,000. How do I know this? I assumed that my variable cost per unit is how much? 40. See here 40. If you multiply 40 with 10,000, how much will come? 400,000. Getting the story? All these are linked with formulas. So when I will share with you the Excel sheet, you can also see these formulas. Okay. Okay, then we moved on to the fixed cost. Okay, please note or tell me in the chat box. Fixed cost we have in totality or per unit basis? In totality. Getting it? I mean, your landlord will not tell you that, I will charge you the rent uh, $100 per unit you make. Not like this, right? He will tell you, Habibi, make whatever you want in the factory. I need this much rent. I need $100,000 rent. Do whatever you want to do in the factory, but do something legal, huh? Getting the story? Okay. So whether you produce the unit or you don't produce the unit, I don't care. I need $100,000 at the end of the month. Getting it? This is fixed cost. Similarly, insurance people will tell you this is your premium. This is your insurance premium, fixed. We don't care how much car you are running, for your car insurance. They don't care. You run 30,000 kilometer per year or 300,000 kilometer per year. They need insurance fixed, right or not? So my friends, again, see here I wrote standard per unit and then I wrote budgeted total. Okay, there is a point to note here, my friends. There are two terminologies. One terminology is called standard. The other terminology is called budget. What is the difference between standard and budget? You need to remember this. Okay. Standard is the word we use when we are talking on a per unit basis. Okay. So we say standard per kilogram, right? Per liter. This is standard. This is called standard. If you remember in process costing what we did in cost management area, so we also use this word standard. Getting it? Even in absorption and variable costing we use this word standard. In activity based costing we use this word standard. Remember, to make one unit we need material handling this much, quality inspection this much. Remember, number of setups this much. It was standard per unit. If you talk in totality, it is called budget, not standard. Getting it? So when I say total, I say budget. Budget means total amount. Okay, now how to get the budgeted amount? If you see here how I got this 1 million orange color revenue, I multiplied 10,000 units with $100 selling price per unit to get this 1 million total budget. This 1 million is what? This is master budget revenue, right or not? Why I am calling it master budget revenue? I am not calling it master standard revenue. Getting it? I am not calling it standard revenue. I am calling it budgeted revenue. Why? Because this is totality. This is what? This is a total figure. So remember this, huh? When we are having a total figure, it's called budget and per unit figure is called standard. Question for you. The question is that standard is based on budget or budget is based on standard. I mean to say that this 1 million is based on this 100 or this 100 is based on this 1 million. Getting the point? Very nice. So see, even we calculated like this. How I calculated this orange revenue? I multiplied the number of units with the standard selling price to get my total budget. Okay, so the answer is budget is based on standard. Standard is not based on budget. Very simple point, right? Anyways, my friends, the next point, fixed cost. What is fixed cost? 15,000 in totality. This is I already told you we don't write in, we can write per unit. Remember, we did in absorption costing and variable costing. We calculated fixed cost on a per unit basis. Remember, when we were doing that reconciliation from variable costing to absorption costing. So we had a formula. Remember, increase decrease in inventory level multiply by fixed production overhead absorption rate per unit. So that we can do. But overall speaking, I mean to say fixed cost is in totality. Anyways, let's move on. So we got to know the gross profit is 585. The variable selling and admin are 50,000. Again, how I got this 50,000? I have this amount here, 5. See here, 5. Okay, let me color it purple or green. Okay, let me color this one green. So when I multiply 10,000 with 5, I got 50,000. This is my variable selling and admin. Okay, see, what is variable cost? It will change with the level of units. The more the units, the more will be variable cost. Okay, but fixed cost will not change with the level of units. Like 5,000 fixed. I'm saying fixed selling and admin 5,000. No matter you sell 10,000 units or 100,000 units. Getting the story? Again, see, in totality, I have written here. This is the total column and this is the per unit column. Okay. Now, I hope all of you are okay with this master budget. Please write yes in the chat box if you got the point master budget. Okay. So to make the master budget, you need to know the standard. Getting it? To make the master budget, you need to know the standard. Now what happened actually, the year has passed and we have reached to the end of the year and we got to know that we sold how many units? 15,000. And we also got to know that the total revenue we have made is how much? 1.6 million. And we also got to know that the variable cost is this, fixed cost is this, variable selling and admin is this, fixed selling and admin is this. Okay, getting it everyone? We got all these actual figures now. Can you see how much is the actual net profit? It's very nice. 823,000. And we budgeted how much? We budgeted 530,000. So very good progress. Okay, this is the comparison between master and actual. There is one comparison between master and actual. Please focus. Can you see this A minus B? What is A minus B? A minus B means master budget minus actual results. When you do master budget minus actual results, you get something called static budget variance. If examiner is asking you calculate static budget variance, so you will use this formula, which is master budget minus actual results or static budget minus actual results. Okay, please write yes in the chat box if you got this point. Okay, what is static budget variance? If you see here, how I got this minus 600,000. I have basically deducted 1 million and 1.6 million. Getting the story? What I have done, see, I have deducted 1 million and 1.6 million to get this answer. Now ask me why this is green. I kept it green because, okay, first of all, I am unhighlighting these things. I already explained you this one. Remaining I will keep as it is. Now see, 600,000 green. You can link from here green. What is green? Green means favorable. Favorable means good. Orange means unfavorable. Unfavorable means not good. Okay. Why we are saying that this is good? Because if you see, actually we have generated more revenue, right? So this is definitely good. Very simple point. Okay. See, this is Excel sheet. That's why I cannot remove this minus here. But in reality, don't confuse in minus plus. I mean, when you are solving in exam, just write 600,000 and favorable. Don't put minus plus. Getting the story, everyone? Okay. Yeah. So in variances, this is, by the way, another topic coming in the next section, which is performance management. And there I will again repeat this thing. Okay. So my friends, now moving on. This is the first type of variance we calculate when we are talking about budgeting. So what is the name? Static budget variance. What is static budget variance? When you compare the master budget with the actual results. Okay, this is done with everyone, right? Now see the variable cost variance. It is 275,000, not good. Why not good? Because we have spent more money. See, we budgeted we will spend 400,000, but actually we have spent how much? 675. So this is not good. Okay, more cost. Similarly for fixed cost, we have incurred more, 2,000 more. Similarly for variable selling and admin, we incurred 30,000 more. See here, 50, 80, 30,000 more. But fixed selling and admin is same, so nil. So this is your static budget variance. Okay, I hope it's clear with everyone. The next thing is flexible budget variance. What is flexible budget variance? It is C and B comparison. It means these two comparisons. You will compare Ferrari with Ferrari now. Okay, in this one what we were doing? We were comparing Corolla with Ferrari. In this one we will compare Ferrari with Ferrari. This is called flexible budget variance, and this is what should have been done. Getting it? So basically in this one I am saying, very nice, I allowed you 20 minutes to reach to the airport, you took 15 minutes. I am saying very nice. I am not considering the car right now when I am calculating static budget variance. Getting it? But when you are calculating flexible budget variance, you are considering the car also. You are saying what should have been done if you took Ferrari. You should have taken 10 minutes, but actually you took how many minutes? 15. So basically 5 is not good. Got the story? And how I know this? Because I am comparing 15 with 15 now. The base is same. Okay. Now see here, in the flexible budget variance, I got 100,000 good. How? Because flexible was 1.5 million. By the way, how to get this 1.5 million? Can anyone tell me how I got this 1.5 million? Very simple. Can you tell me how I got this? By the way, formula is also here written in the formula bar. You can tell me easily. Very nice. 15,000 multiplied by 100. What is 15,000? 15,000 is the actual units. And with what is 100? 100 is the standard price. So from here you got to know how to create flexible budget. Formula to create the flexible budget. Okay. By the way, this is a question in exam. They will ask you how to create flexible budget. They will not say prepare flexible budget. They will say how to create flexible budget. So what is the answer? You will say, when we are creating a flexible budget, we need to first of all take the actual units, and then for the full income statement, we need to multiply the standard price or cost or whatever it is with the actual units. But if it is fixed cost, we take the master fixed cost. I am coming to it in a while. Okay, this is the answer. Anyways, all of you are okay with this 100,000 green? Please write yes in the chat box if this is okay with everyone. 100,000 green. Okay, moving on, my friends. Let us talk about this 75,000 orange. Okay, again, how I got the 600,000? Can you tell me how I got the 600,000 variable cost? Very simple. The same way I got this 15 million, 1.5 million, sorry. So see, how to get this? You will multiply the 15,000, which is your base basically, and with the standard variable cost per unit, which is 40. So 15,000 multiplied by 40 is how much? 600,000. Getting the story? Again, when I compare 600,000 with 675,000, how much is coming? 75,000. Not good. Why? Because again, see, 600,000, I am saying you should have incurred. What I am saying? You should have incurred variable cost how much? 600,000. But actually you have incurred how much of the variable cost? 675,000, which is not good. Okay. Moving on. Okay. Now can you tell me how I got this 15,000? How I got this 15,000? So please make a note of it now. While we are making flexible budget, we don't flex fixed cost. What do you mean by flex? Flex means what we just did above, basically. How we calculated 600,000. This is called flexing. You take the actual data and you multiply with the standard per unit. This is called flexing. Okay, fixed cost we don't flex. What we flex? We flex the revenue, we flex the variable cost. Two things we flex. Fixed cost we don't flex. So what we do with the fixed cost? We take as it is, as it was in master budget. Getting it? So how much was the fixed cost in master budget? Remember, 15,000. So basically, if you see what I have done here, I have linked like this. See how I linked it? I said whatever is written here is my answer here. Getting it? This means whatever is in the master budget, this is my answer here. Okay. Moving on, again, you know very well how to flex this. We will flex variable selling and admin. How we will flex? 15,000 into 5, this is my answer. But we will not flex this. So again, what I did, I took it from the master budget as it is. Okay. So basically, this should be okay with everyone now. These three columns. If these three columns are okay with everyone, please write yes in the chat box. Okay. And this also should be okay with everyone. See, this one I already explained you. This is the difference between A and B. And this is the difference between B and C. Okay. Now, my friends, very, very important point. What is that point? There is something called volume variance. Okay, this you will again come to know when we will do variances. Okay, there are two types of variances mainly. One is called volume variance, that you plan to sell 10,000 units but you sold 15,000 units. So what is the variance resulting due to change in volume? It is called volume, right? Volume means what? How many units you plan to sell, how many units you actually sold. This is called volume. So we need to know how much variance is relating to volume. The second variance is relating to price. That you say, okay, we plan to sell for this much, but actually we sold for this much. Relating to price. Okay. Now, examiner can ask you this question, that static budget variance minus flexible budget variance is what? Getting it? Static budget variance minus flexible budget variance is what? So the answer is, it is volume variance. So the difference between static budget variance and flexible budget variance is volume variance. Getting it? This can be a theoretical question also, this can be a calculation also. So they will say, okay, static budget variance is 600,000 favorable for revenue. Flexible budget variance is 100,000 favorable for revenue. Please calculate how much is volume variance for revenue. Getting the question? So what you will do? You will net off these two answers. Okay. Again, see the problem now. If you will net off these two answers, you will say 700,000. How much you will say? 700,000, right or not? Because both are favorable, right? Or not? These both are favorable, right? But the answer is how much actually? The answer is 500,000. Because we need the difference actually. We need the difference, not the totality. See the formula I am writing for you here. Static budget variance is equal to flexible budget variance minus volume variance. Sorry, plus volume variance. Getting it? So basically, static budget variance is the combination of two variances, flexible budget variance and volume variance. Got the point? I mean to say that, if I create one small column here for you, like this. So this is basically the total answer of these two. Getting the story? This one, this static budget variance is the total answer of these two, right? So now you will see like this. 500 and 100 is how much? 600. 75 and 200 is how much? 275. 2,000, 2,000, and 5,000 and 25,000, how much? 30,000. So the combination of flexible budget variance and volume variance, when you merge them, you will get static budget variance. This is the formula I wrote for you below. See this one? I wrote for you, so don't forget. Okay? So he can ask you anything here. He will give you flexible budget variance and volume variance, and he will say calculate static budget variance. He will give you static budget variance and volume variance. He will say calculate flexible budget variance. Getting it? Any combination he can give you, but you need to remember this formula which I wrote below for you. Now see how to do this plus minus. Very simple. They are saying you that static budget variance is 600,000. So the first thing will come in your mind is what? You will say static budget variance is the difference between the master and actual. First of all, you should remember this. Then they say, okay, flexible budget is 100,000. Good. Now it should come in your mind. What is flexible budget variance? It is the difference between flexible and actual results, right? And based on this formula, what you will do here, you say, okay, 600 is equal to 100, right? And plus X, right? Or not? Getting it? And 600 is also good, 100 is also good. If I need X, what I will do? I will take this 100 on the other side or not? Getting it? When this 100 will come on the other side, this will become what actually? Minus. Getting it? Now see, if you are still confused, let me tell you. This 600 is green. This 100 is also green. Okay, let me keep X separately. Okay, I need X. Now what I need to do if I need X? Tell me. I need to shift this 100 on the other side or not? I am not saying this is plus or minus, just green. Green means good, favorable. So when this will go on the other side, this will become unfavorable. Getting it? Same like plus minus, but I am not using plus minus. Anyways, so the answer will come how much? 500,000. Good. Because already 600 is there, so I will copy paste this thing here, and I will keep this thing here also. But this time this will become orange. I will keep it orange because I am throwing it on the other side of the equation. So this will become like this. Getting it? So the answer will become how much? Okay. So I hope you people got this point. This is very simple point. Anyways, just because you can do a big mistake here if you will not remember this point. Okay, of plus and minus. Anyways, again, static budget variance is the combination of two, flexible budget variance and volume variance. Now see, examiner will ask you a very interesting question. They will ask you, flexible budget variance is a price variance or a volume variance? What they will ask you? Flexible budget variance is a price variance or a volume variance? So the answer is what? Price variance. Below I wrote already for you that flexible budget variance is a price variance. Now what do you mean by price variance? Let me tell you. Okay, first of all, tell me how we calculated this column, this one. How we calculated the flexible budget? Remember, we use the actual base, which is 15,000, and we multiplied with the standard price, the standard variable cost, like that. Okay. So when you will compare these two, are we fighting on volume? Tell me yes or no. When you will compare actual with flexible, are we fighting on volume? Volume means the number of units. Getting my question? We are not fighting on volume because volume is same. 15,000, 15,000, same. Ferrari, same. Getting the story? What we are fighting for? We are fighting for price. We are fighting for price, not for volume, because volume is same, base is same. I mean to say that this 1.6 million revenue and this 1.5 million revenue. The difference in this only is due to price, not due to units. Because this 1.6 million is also coming from 15,000 units, and this 1.5 million is also coming from 15,000 units. It means I am fighting on what? The multiplication of the price. Okay, tell me, my friends, in the chat box, how much is my actual selling price? If I ask you, how much is my actual selling price? How to know this? This divided by this, right? So 1.6 million divided by 15,000, which is 106 something you are telling me. It means that we have sold for more price. Getting it? We thought we will sell for 100 per unit, but we charged the customers more. We sold them for how much? 106, which is good. Good or not? Yeah, this is very nice. It means the price is very nice. That's why this is green here. See, green. This green, if you can see here, this is green because we have charged more price. If we charge less price, this will be orange also. Anyways, my point to make was, I wanted to make this point that if examiner is asking you that flexible budget variance is a volume variance or a price variance, so the answer is it is a price variance, because we are fighting on price, not on volume. Volume is same. This 15,000 and 15,000 same. We are not fighting on volume. Okay. So here below this working, if you see, I have written for you some theory. I have written we will use the actual units and multiply them with the standard per unit figures. This I already told you. This is how to create flexible budget. If examiner is asking you how to create flexible budget, this is the answer. Okay, then you will tell also revenue and variable cost will be flexed, but fixed cost will stay the same as in master budget. Again, I have already explained you this. Okay, and if examiner is asking you is the flexible budget variance a price variance or a volume variance, so what is the answer? It is a price variance, and I already explained you how this is a price variance. Getting the story, everyone? Okay, so this is the, actually we have not yet started the question. I am just explaining you what is the flexible budget. Please write yes in the chat box if you got the point. So my friends, returning back to our question, this one on Biscayne Industries, right? So see, all of this information which is given to you here from the last year data, which they say we will take it as a master budget. So see, I have plotted this information here. Okay, this is that figure, these figures. See, master. Okay, when we are doing this exercise, I am doing number 2 first. Okay, number 1 I will come to it after doing question number 2. So we are preparing the flexible budget for this company. Now see, this examiner is telling you that create the flexible budget from operating income, which is 55 million. Okay, but I told you a while ago that we create flexible budget based on number of units. Remember here, we took units 15,000, 15,000. Okay, now the point to remember is if the units are not given to you, we take revenue as base. Okay, like for example, if in this example I am not giving you this information, so you will take 1.6 million over here. In the flexible, you will take base as 1.6 million. Getting it? And this is the same in this question basically. An examiner is telling you that please use 55 million as your base. And what is 55 million? Remember, 55 million is my actual sales, right? So going back to the Excel sheet, first of all, if you see, I have plotted all this information from the question, which is this one. I have sold 100,000 units, total 50 million. This is basically last year data, which is master budget. 50,000, 30,000, 20, 12, 8. The only thing I have done here is I have broken down this information. Can you see this? I have broken down the variable cost and fixed cost, which we were talking about in the question earlier. Remember that this 30,000, this figure is 2/3 fixed. It means 20,000 is fixed and 10,000 is variable. So I have written separately like this. 10,000 is variable and 20,000 is fixed. Right? Now my friends, remaining everything is same. This is just a copy paste of your question. Nothing from my side. Okay? Remember I told you when you are creating a flexible budget, how many columns you need to make? 3 columns. The first column is master, the second column is actual, and the third column is flexible. Right? Now see the actual column, we have been given information that the actual column, the actual sales are 55 million and the actual operating income is 7.5 million. Only these two information they have given us. So I went here, I wrote 55. Basically we are working in thousands. Okay, so I am writing all the figures in thousands. So 55,000 is my sales and 7,500 is my operating income. This yellow area I don't know. Question mark. Examiner is not telling me any information about this area. That how much is your cost of sale, how much is your selling and admin, we don't know. Now we need to create a flexible budget. To create the flexible budget, we need the units. We need the actual units. But examiner is not telling us actual units. So see question mark, I don't know. If he is telling me, I will keep same here. Now remember he told you take 55 million sales level as your flexible base. So remember this is my base now. If units are not given, I will take revenue as my base and I have done this. Then they are saying, okay, how to calculate the variable cost? Remember we will flex it. How we will flex it? We need to know how much is my standard. How to know the standard? How much is your variable cost in master? 10,000. If you need to know the standard, what you will do? You will divide this 10,000 with 100 to know how much is per unit. Remember per unit. Variable cost per unit. So 10,000 divided by 100. And I need to know how much is my actual units, which I don't know. So basically that exercise I cannot do here. So what I will do is, I will divide 10,000 with 50,000 to know that how much is my variable cost per dollar of sales, because I don't know the actual units. So what I did, I will divide 10,000 with 50,000 to know how much is my variable cost per dollar of sales, and I will multiply with the actual sales to know how much my variable cost should be. How much my variable cost should be. Getting the point? This is the flexible budget, that how much should be there based on the actual sales. And this is the formula I wrote for you here, that how I calculated this information. Getting the story? By the way, I have done the same exercise for you here, which I showed you before. This is not required, but I have done for you for your information. So you will remember this. Okay. So first of all, I am writing here how much is standard per unit. How much is standard per unit? 50,000 divided by 100. Right? How much is standard per dollar? We don't know standard per dollar. Getting it? Because we don't have this information. Now see here, I wrote here for you. This is irrelevant because actual number of units are unknown. We don't know the actual units, so we cannot use standard per unit column. Getting the story, which I used in my example before. Therefore, you have to calculate standard per dollar figure because sales dollar is the base. What is the base now? Sales dollars, right? So this is our base. So we will use basically this information, these two information. Okay. So my friends, I hope it's clear for you. Please write yes in the chat box if you got the point. So basically, all of you should tell me that this 55 million is very simple. Examiner is telling you himself, please take 55 million as the base. So we took it as it is. Now how to calculate variable cost? You will go to the master budget. You will say, okay, 10,000 is my variable cost divided by 50,000 multiplied by 55,000. So variable cost should be 11,000, right? Again, fixed cost, remember, we will flex fixed cost or not. Remember I told you, we only flex what? We only flex variable cost and revenue. We don't flex fixed cost. So fixed cost you will take as it is, 20,000. Remember, see how I did this? Exactly same 20,000 I took here, not to be flexed. Similarly, selling and admin I will not flex, I will take as it is, fixed. Right? Total how much? 12,000 operating income flexible. So this is the answer for question number 2. When they asked you to create flexible budget, you will only create this green area in your exam screen. All this remaining is just for your note. They will give you a notepad to do your calculations. You will do there. Don't write all this on the screen. Only what you will write, only this green area. You will tell them how I got the 12,000. Okay, everyone clear with you? So my friends, now we will discuss question number 1. They say what are the 3 benefits of flexible budget? So I have written for you here. See, normally flexible budget is used when the actual results have arrived. It means at the end of the year. That is called evaluation tool. Okay, that means what? Evaluation tool. What is evaluation? When the actual results have arrived, you use flexible budget to compare, Ferrari with Ferrari. After the driver has gone to the airport, So that is after the actual results have arrived. You try to compare. You can also do flexible budgeting at the planning stage. When you are making the master budget, you can make different flexible budgets on different levels. This is also called scenario analysis, sensitivity analysis. You are trying to see what will happen if we sell 200 units, what will happen if we sell 300 units, like that. Okay. So this is also a planning tool. Then this is also a contingency tool. Contingency tool means, during the year. Maybe during the year something unfortunate has happened. The market is going down. Some natural disaster has happened. So you need to adjust according to that scenario. Okay, so during the year you can also create flexible budget. Okay, this is for your reference only, but you can write this in exam also, because in exam they are asking 3, so you will write only 3. If they are asking 4, you will write 4. Now, what is the fourth advantage? It can be calculated that how much of the static budget variance pertains to price and how much of the variance pertains to volume. Remember how to remember this? This is what we have done here. Remember? We got to know that how much of the 600,000 is relating to price and how much of the 600,000 is relating to volume. Getting the story? I mean to say that we are saying we are very happy that we have generated 600,000 more revenue. So you want to know that this 600,000 more revenue is due to charging more price or due to selling more units. So we got to know that, okay, out of the 600,000, only 100,000 is because of charging more price. The remaining 500,000 is due to selling more units. Getting it? So basically the sales team has performed very well because we have sold 15,000 units, 5,000 units extra. Okay, I hope you got the point. What is the benefit of flexible budget? Again, we can trace how much of the variance pertains to volume and how much of the variance pertains to price. Okay, please write yes in the chat box if you got the point. Okay, question number 3 is very simple. Okay, this is you will read through it later on. They are asking you that identify and explain 3 possible reasons why sales have increased but the company income has decreased. You can have numerous possible reasons. Let me show you some of them which we have here. So we are saying that, okay, sales price may have been lowered, resulting in increase in number of units sold but decreased margin. So when you want to increase the sales, what you do normally, you reduce your selling price to increase your demand. Getting it? So in this situation, what will happen? Your margin is going down because your margin is how much? For example, your selling price is, like in this question, we don't know exactly how much is the, we know how much is the selling price. 500 is the selling price standard. So maybe we have reduced the selling price to 495. We have reduced the selling price to 490. Getting it? To increase the number of units sold. We don't know, right? So we cannot comment on this, but we can write overall possible reason that sales price may have been lowered. Because we need to tell the examiner that why sales have increased. First of all, we need to tell him why sales have increased. We say, okay, the price is lowered to, to increase the number of units. But the margin is decreased, and because of that, the operating income has decreased. Now see here, the second point you can write is, due to cost of sale, fixed cost. Fixed cost, what is fixed cost? In cost of sale, resulting to production overheads, right? This production cost. Increase in factory rent due to having additional space. So for example, we were having a certain number of units we can make in the factory. If we need to cross those units, we need additional factory space. Okay. This is a sudden jump in your fixed cost. So maybe that has resulted, because see, we don't know this yellow area basically. So we can give a possible reason. We don't know what has happened, right? So we are assuming here that in flexible budget, the fixed cost will stay the same, 2020, but maybe in between here, it is 30. We don't know. Maybe this is 25. So we are giving a possible reason that maybe the fixed cost has increased. Getting the story? Now, what is the selling and admin fixed cost? We are saying, okay, the marketing and advertisement expenditure may have increased also. Because see, how much sales have increased? This is not 5,000, this is 5 million. Because I am writing in thousands. So 5 million sales have increased. Maybe we have spent a lot of money on research and advertisement. Okay, tell me in the chat box. When you spend money on research, when you spend money on marketing and advertisement, the output will come immediately or it will take some time? Tell me. Like you start marketing today. So today you will start getting the sales also? No, right? It will take some time. Maybe the marketing you are doing today, you will get sales after for example, 1 month, 2 months, 6 months, you never know. Getting the story? So maybe this is not 12,000 here. This can be maybe 20,000. We don't know, 25,000. But the resulting impact has not come in this year. Maybe next year the sales will cross 70,000. We don't know. Maybe the sales will cross 100,000. We have done a lot of marketing. Getting it? So this is the third point you can make. Again, these are all possible reasons. We are trying to tell them. But again, my friends, the reasoning should be logical. The reasoning should be logical, because what is the logic we are trying to make? We are trying to make a logic that sales are going up, but income is going down. Why? Getting it? So we said, okay, we needed additional space. Our fixed cost have increased suddenly. It's called step fixed cost. Or we have done a lot of marketing expenditure, but the sales have not increased to that level in this year. Maybe next year it will increase more. Getting it? What about the last question? Very simple. They say define zero-based budgeting approach. So in zero-based budgeting, what we do, we start from scratch and we have to justify every line item, and there is a very less chance of budgetary slack. Okay. So here I have written this for your information also. Something about the authoritative budgeting and participative budgeting approach. What is authoritative budgeting? Top-down approach. The top management will impose the budget. What is the good thing? It is time saving. What is the bad thing? It will create demotivation. Why? Because you are imposing something. Opposite is participative budgeting, in which it is a bottom-up approach. There is a motivation because you are involving people, right? But at the same time, it is time consuming. Examiner can ask you. And then there is a middle approach. You ask them, but still you impose your decision. You listen to them, maybe you change your decision and then you impose. Depends. Which one is good? You cannot say that this one is good. It depends on situation to situation. A company's new brand, company, people have less experience, so maybe you will go for authoritative budgeting. Company is already established, people, they know the business more, the ground staff knows the business more. Better you go for which budgeting? participative budgeting. Getting the story? Examiner can ask you, by the way, he can give you some scenario. He will say, okay, please let us know which budgeting approach is suitable for this company. So at that time, you need to remember these points. Then my friends, you have incremental budget. What is incremental budget? From the last year figures, you add certain percentage on it. Getting it? Like for example, in this question, they said take the last year as it is. Instead, they can say, okay, take the last year, add 10% on it. So on every figure, you will add 10%. This is called incremental budgeting. Okay. What is the benefit? It is quick or not? Very quick. Yeah, you just need to put one formula. Answers will be there. But what is the problem? Budgetary slack. Because you are using a last year figure and you don't know that is justified figure or not. Okay, and what is the solution for this? You can go for zero-based budgeting approach in which there is less chance of slack because you are asking them to justify everything. Remember pocket money example I gave you. So instead of $50 now you will give only $35. But it is time consuming. You need to spend some time on it. You need to do some meetings, some negotiations, many things. So anyways, this is extra knowledge I am giving you apart from this question. And this is the completion of this question on flexible budget. Question number 3, Biscayne Industries.